Okay. So here we are. Yes. Okay. So let's start with monopolistic competition. Okay. And return to this part. Okay. And this is not the optimal price. Okay. So notice that the optimal price will be, in fact, this one. So the epsilon should be in the numerator and epsilon minus 1 in the denominator. Notice that epsilon is greater than 1 in the example, right? So this markup term epsilon over epsilon minus 1 will become either 1 if epsilon is very, very large. So that means very substitutable across varieties. And if epsilon is close to 1, this markup will be very, very large, like close to infinity, even if assuming it's close to 1. Okay. So what this also should tell you is that there's a distortion because under perfect competition, price is equal to marginal cost. But here, marginal price is not equal to marginal cost. There is this markup here. The markup is the same across all J's, all J varieties. And if you notice, if this is true, if this equation holds, then all varieties will have the same price and they'll have the same markup over marginal cost. Okay. And marginal cost is given by this term here, which is just the real wage divided by A, which is the marginal product of labor. Okay, because your production function here essentially just has labor, and the marginal product of labor is essentially A. Okay. So I like the slides because it helps put together all of the equations. But let's return to the discussion here. Okay. Now, this is also incorrect. This should have, if you plug in the optimal PJ or PT, I should say, it will not be this. The rest of the book is corrected for it. But I guess the only point remaining here is that if all varieties have the same price, then all varieties also have the same output. Okay, so that's essential. And since output is the same across all firms, you will also hire the same N. So NJT is equal to NT. Also based on the production function here. If YJ is the same for all firms, then NJ is also the same for all firms. Okay. So here we've got aggregation and equilibrium. I'm going to follow roughly the presentation in the book, but just to prefer speed, right? Speed over the presentation. Feel free, of course, you must read the book. Once you aggregate, notice what's going on with your Y. Your Y is just going to be basically A times big N, where N is the total labor supply in the economy. Okay. And this comes from integrating all the different YJs here, which again, they're all the same YJs, right? They're all the same YJs. So once you integrate this, okay, it will become this thing here, okay? This is going to be possible. So you don't need to know integration for this class, but ultimately, guys, if everything inside the integration is constant with respect to J, you can basically remove it from the integration and then basically, and then the epsilon minus 1 over epsilon, and then the epsilon over epsilon minus 1, those two exponents cancel out. So that's why you have A times N. Okay. All right. Now let's go to the one of the more important results here, guys, which is the price index, right? So notice that you have 1 here, which is the value of the price index. Okay. Okay. It's 1 because for the optimization that we had, there is no explicit P or price index here times the time which multiplies to Y, right? So therefore the price index has been set to 1. Okay, has been normalized to 1. So the overall price index or the overall price in the economy is set to 1. Now, if you insert all of the definition of each price, which is again just the markup and the marginal cost, then once you um, do the math here, again, integrating, removing out, notice that you remove the PT from the integration here because it's constant with respect to DJ. So what this is basically this one becomes 1 itself. And then this is the same as when you plug in the optimal P here. Now, because this whole thing is equal to 1, then for this whole thing to be equal to 1, then that means MC has to be equal to epsilon minus 1 over epsilon. So the marginal cost is given by the inverse of the markup. And that's one of the key results. Why? Because if you notice, from the definition of marginal cost equals W over A, right? And therefore, you also know what marginal cost. Marginal cost is equal to the inverse of the markup. And therefore, the wage or the real wage is equal to the inverse of the markup here times A. So notice that W is no longer equal to A in the monopolistic competition. W is going to be less because it's going to be multiplied by this fraction here, which is less than 1. And under perfect competition, wage equals marginal product of labor, which is equal to price. Okay, so that's one of the major takeaways from this model. So I want to make sure that everyone has followed that, and because that will come into play in the not optimization, in the welfare analysis to follow. Any questions so far? Okay. So all of this comes from the fact that price exceeds marginal cost by a constant markup. So we go back to the social planner problem. And according to the social planner problem, your optimality condition will be this one, which we've done this before. Okay. And at the optimal point, it has to be equal to the marginal product of labor in this case, because there's only one factor. Okay. And we're only really talking about labor in this particular case, because this is the labor, leisure, and consumption trade-off here. And it has to be, the MRS of that has to be equal to the MRT. In the decentralized equilibrium, that same ratio has to be equal to W. And that's why if W equals A, which is true under perfect competition, then the decentralized is the same as the social planner. Okay. So any questions about that? Okay. That also comes from an earlier chapter in the book GLS. But notice again here that the wage or the real wage is less than A because of the inverse of the markup. And that's one of the key implications of monopolistic competition model. So this will have implications for the macro labor share. So I'm just going to introduce to you guys to the 16.3, which is the following. Okay. And under perfect competition, your labor share is just this. If you recall your Cobb-Douglas production function, your labor share is just equal to 1 minus alpha, which is the coefficient of labor here. Okay. It turns out, generally speaking, with market power, with a constant markup here, then the labor share is going to be less than 1 minus alpha because it's going to be multiplied by something that's less than 1 here. Therefore, under market power, the labor share will be forced to go down. Okay. So, kita niyo yung mangyayari, right? The prices are going up. Okay. The amount of output will go down. The labor demanded will go down, essentially. And then the wages will be inefficiently lower then because you're going down the labor supply curve. That's the problem with a monopoly. Your output is not high enough, therefore your labor demand is not high enough, and your labor supply will also not be high enough. Any questions? Okay. So now is the time to ask the questions on the general themes of monopolistic competition. Okay. So hopefully everyone's got that. Now, let's go for something more general. Okay. So now instead of going to one, okay, we're sort of trying to understand what happens to our model when the measure count of sellers can be endogenous. So instead of just one, you have this can go up and down, okay, making M endogenous. So using the same price index, recall that the coefficient of Y in the optimization is still 1, and therefore the price index is overall still 1 here. If you do the math, if you just follow the steps, marginal cost is also epsilon minus 1 over epsilon, but it's also going to be multiplied by this one. So before, no m is equal to 1, this was equal to 1. But now that m is generically some number, some integer, what you'll see here is that as the number of varieties rises, the marginal cost will tend to rise. Okay, and the real wage will also go up as the number of varieties will rise. Okay, so this immediately will tell you what's going on with welfare, because as the real wage is rising with the number of m, so that's a good thing. Okay, because workers, which who are the only consumers here, they are only factor of production. Their welfare will tend to rise. The same sort of conclusion will be apparent under Y or GDP, right? So if you do the math and you replace YJT with the optimal Y, with the M being endogenous here, then what do you see? It's essentially the same as earlier, A times big N, but now it's going to be multiplied again by M raised to 1 over epsilon minus 1. So because epsilon is greater than 1, this thing is a positive number, and it will add to a higher M will add to a higher Y. And that basically also is another message from the monopolistic competition literature, that the more varieties there are, the better off output is, okay? And also the better off real wages are, okay? It's especially most powerful when epsilon is very, very close to 1, right? When epsilon is very, very close to 1, that means each variety is very, very unique and very special. So having more of those special varieties ultimately will raise GDP. Okay. Finally, what determines M? And this is one of the key questions in one of the uses of monopolistic competition, guys. So if you use monopolistic competition in growth models, the thing that will drive the growth in GDP is not just the change in the N or the inputs, not even just the change in A, but also the number of varieties here, M. So one of the sources of growth under monopolistic competition, which will create endogenous growth, if you will, is changes in the number of varieties. So over time, the number of varieties will rise, leading to an independent effect on GDP. So if you were to go beyond the solo model and go to something like an endogenous growth model, which is sort of the next level in the growth literature, right? The next step to think about where long run growth comes from. This is the endogenous part because M is endogenous. Okay. M is not a black box, or it isn't just growing at some exogenous rate like in solo. So M is determined within the model itself, right? So what will determine M? This is your D, or your profits per firm. This is this. Okay. So notice that this is your Y essentially, right? You just replace this with Y, and then the P and then MC will be here. So this is your profits, right? You will sell this much. This is your Y, small y. And then for each small y, you will gain this much operational profit, P minus MC. Now, if you substitute P, so notice that the Y is in fact this one, guys, if you take a look at this, right? Epsilon over epsilon minus 1 MC raised to negative E. That's the P raised to negative epsilon here. Okay, so this is the correct one. When I said earlier that the error or the typo in the book was corrected, this is what I meant by that. Okay. Now, the big Y is just going to be this one. You recall? ANM 1 over epsilon minus 1, which is just this thing here. And then P minus MC is just MC over epsilon minus 1. So all of these things are just simplified versions of the earlier line here. So once you um, simplify it in terms of M, you will get this expression here. M raised to 2 minus epsilon over epsilon minus 1 times A times N, N raised to epsilon over 1 minus epsilon. Now, if you solve, so normally there will be an F, which is your fixed cost of entry. Now, if you have a fixed cost of entry, you have to compare the operational profit here to the fixed cost of entry. And this is what's called a zero profit condition. So this entails your profit, your D, essentially, to be equal to zero, right? Because you will enter until there's no more profits to be had in the industry, in the differentiated goods industry, basically. And that will allow you to solve for M here, right? So what is the solution to M? Well, here's a solution to M. And I'd like you to point, I'd like to focus directly on this ratio here, F, which is the fixed cost, and A times N, which essentially is sort of the size of the market. So notice that A times N is essentially a key part of GDP. Yeah. So the larger the F is, okay, what is the effect on M? So normally you might think that if you have a high F, it's harder to enter and therefore you have fewer firms. And that would definitely be true if epsilon were to be greater than 2. So if epsilon is greater than 2, notice that this coefficient here is a negative number because epsilon is greater than 2. And therefore, a higher F leads to a lower M. But it really depends on the size of epsilon, right? And I go back again to yung interpretation ng epsilon. So epsilon being high means that goods are substitutable. So you have the normal situation where a higher cost of entry leads to lower, fewer firms. And similarly, higher market size will lead to more firms coming in. Okay. But something interesting or magical happens when epsilon is close to 1. When epsilon is in fact less than 1 or close to less than 2, but of course greater than 1, then suddenly market power is that much more powerful, right? Market power is that much more powerful. And what you'll have is a concentrated industry, basically, in that a higher F here will lead to more M here, which is sort of an odd situation, right? So it's harder to enter, but then firms are more profitable under the situation where epsilon is almost equal to 1 or less than 2. And that's why you have this positive relationship here between F and M. Okay, because an epsilon that's close to 1 means firms are making a lot of operational profit. So that's why you experience this positive correlation between F and M. Okay. Yeah, but ultimately the point here, guys, is the M in the future, if you were to do like more macro modeling using an industry which has market power, you'll find that if you're interested in economic growth, that M here will be a variable that's sort of pushing GDP up, as you'll see here, right? So this epsilon doesn't really matter if it's equal, greater or less than 2. So whatever the epsilon is greater than 1. Higher M will lead to higher GDP, and that's the endogenous part of the endogenous growth model. All right, so any questions at all about monopolistic competition? I think these slides are online as well, in Uvle. Just want to confirm. I don't know if you've seen it, but you should take a look at those slides as well as the video. Maybe those are some of the key points really that you should remember when it comes to monopolistic competition. Any questions about monopolistic competition? Okay, we're good. Okay. So does everyone see has everyone tried the homework?
Hi, sir. Regarding po sa homework, may question po ako. Is it okay to ask po?
Yes, go ahead.
Doon po sa first part, I think mayroon po atang typo
Mm,
dito po sa letter B na pinapahanap po si individual consumption and aggregate consumption equal to lambda and price po.
okay.
I think dapat po ata yung exponent ng aggregate consumption is 1/epsilon. Na
Mm-hmm.
nakalagay po kasi sa homework it's raised to negative 1/epsilon po.
Okay. So let me take a look at that. Just gonna stop sharing first. Ano ba mag-stop sharing? Okay. Ito muna yan. Yes, you're correct.
Noted po sir, thank you po.
Dapat this should be C raised to 1 over epsilon lang. Okay, so there should be no minus there. I'm gonna note that. And then I'll write a correction into Uvlet, into the reminder of the homework. Okay. So you'll know that this is a problem because take a look at the book. Essentially, it follows the same logic as the book, except the coefficients are different. I'm just gonna reshare this one here. Well, let's use this one na lang since I have it. Nakikita niyo naman yung ano, no, yung PowerPoint?
Yes po sir.
Yeah. So essentially, it's going to be something that looks very similar to this, right? And one of the reasons why it should be a different, well, it's not the same. What am I looking at? Ano ba siya? Where? Ah, yes, I was going to point this out. So if you'll notice, if you do the same, this is essentially the same as the one in the problem set. This demand function here, which is essentially what you have there in the other one, except that in the problem set, naging C siya instead of Y. So that's the reason why it's wrong. Thank you. Sige. Any other problems? Okay. So first, just set up the maximization problem with respect to this. This one, you'll see immediately that this cannot be correct. That's fine. How about question C? No problems? Okay. So what's the cool thing about this one, guys, is take a look at this. If you have something that looks like this, M is your total income, right? Which is at this point sort of exogenous. Your negative lambda is multiplied by C, and therefore your negative lambda will be essentially the price index. So in the book, the price index is equal to 1. But here in the homework, the price index will not be 1. Okay. The lambda raised to negative 1 will be the price index. Okay. And you can call that P. Okay. Then you solve for P itself. Okay. And then you get an expression for it. Okay. Then finally in E, not finally, but in E, then you'll solve the profit max, and you get the optimal P, right? Okay. And it will give you a price that's a constant markup over MC. So there's another way to practice to get that constant markup expression. And then finally you get the price index that you solved in D, and then you plug in the individual P's, and then you'll get something that's a function of n varieties. And then you can show that the price is falling in n. So this is another way of thinking about GDP, right? But now instead of thinking about GDP, you're thinking about the price index, right? So in this particular case, pag tumataas yung number of varieties, pag nag-increase yung number of varieties, the average price level will be falling. And that's one of the major conclusions here as well. Right? So not one way to interpret the number of varieties as an increase in GDP, and another way to interpret the rising number of varieties is a falling price index. Okay, which is also related, by the way, to the increasing real wage also. Any other questions on the homework? So it's meant to be sort of another practice, another application of monopolistic competition, similar to the book, but now using consumption naman instead of GDP or output. Okay. All right, everyone. Let's continue. So our next topic, guys, is in fact open economy macro. So these are some of the slides that are in Ovle already. So we will go through them. As you will see, a lot of this is conceptual because all of the analytical stuff you've learned already. Okay. The analytical stuff will basically be an intertemporal approach to the current account. And that will be mathematically, it will be identical to what you've learned in GLS in the textbook. Okay. But first, let's go for an explanation or a discussion about global imbalances or about the state of current accounts and financial accounts around the world. Okay. So some of this also will be a review because the basics of this we also talked about in a previous class, the 101. All right, so we begin here with global imbalances. Okay, so countries trade a lot with one another. The focus of this textbook is
Okay.
again. I'm sorry,
Sorry po.
we're not. I'm not yet sharing this one, right? Sorry.
Okay po. Apo.
Let me share this one. Okay, everyone can now see the slides. So these
Mhm.
are chapter
Yes po.
one, global imbalances. from again, the slides are on Uvlit. So some of the big questions here are um, the trade deficit. Okay. Does a particular country have a trade deficit or a trade surplus with the rest of the world? What about China, Europe, Latin America? Okay. Um, is there a relationship between the international asset position and the trade balance, and how has this evolved over time? So now we'll continue. Um, let's get this out. Yeah, right. Okay, so this chapter will be very conceptual, right? But in later chapters, we'll talk about the analytical framework behind this, and we'll ask questions about, so why do some countries run trade deficits in some years and trade surpluses in others? Okay. Can countries borrow forever? What determines the size of a country's external debt? Okay. We won't go through all of these questions necessarily for the rest of the class because there's only two meetings left. But these are the topics that you will get that you will find in international macro. So hopefully these discussions here will be inspirational to think about these very important issues. So geography of external debt. So let's take a look at the heat map on the next page. It displays with colors the accumulated current account balances between 1980 and 2017. So accumulated ito because you're adding up all the different current account balances. Okay. We will determine current account balances more precisely below, but roughly speaking, it's the difference between exports and imports of goods, factor payments and services. As a result, the country's current account balance in a given year is about equal to the change in the country's net external debt. Okay. So this is an important concept which I can introduce right now. So the current account balance is in fact not a stock but a flow. It's a change. It's a change in the stock of the country's net external debt. Okay. So if we add up a country's current account balances for those years, we get the change in its external debt between 1980 and 2017. The map shows that the country with the biggest accumulated current account deficit is the United States. Its cumulative deficit is $11 trillion. The countries that have been financing these deficits are in the deep green are Japan, China, Germany, and oil and gas exporting countries, members of OPEC, Russia, and Norway. So overall, the picture is one of unbalanced trade with some countries running long-running current account deficits, like the United States, and others running protracted surpluses, like those countries mentioned earlier, China and Japan, Germany. If all countries were in balance, the map would be white. Okay, instead it looks either red or green. So these reflect these global imbalances. Okay, so we'll see that here. Where the red ones are the ones with the deficits, okay, and the green ones are the ones with surpluses. Notice here, very interesting. The Philippines is actually a light cumulative surplus, which is in fact consistent with the Philippine data. Okay. So to do that, I'm going to show you the Philippine BSP balance of payments data here. And in a previous plot, we plotted this, right? In the previous class, we plotted this. And look at the current account as percentage of GDP. For most years, so hold on. This is annual. The first annual observation here is 2005. You could probably get something earlier if you dig into it in, say, a library somewhere. But what the book is saying, and as well as the official data that we have here right now, if you take a look at this, a lot of the time, especially before 2017, 2018, we have been running a very, very small current account surplus here, right? And it's only after 2017, 2018, 2019 when we have been sort of up and down, either a surplus or deficit. So we've turned from a light green into fairly white situation for the current account. Let me change the share again. Okay. Yeah, so the Philippines data and the other one that I just showed you was, in fact, 2005 until 2017, where, again, most of the data points for the Philippines has been a light CA or current account surplus, which is consistent with this graph that we see here. Although things have changed since 2017 from 2018 onwards. Okay, international transactions accounts. They're recorded in the United States by the BEA. Okay. The balance of payments has three components, which is also true for the Philippine situation. Yeah. You have the current account, the financial account, and the capital account, which is quantitatively small and unimportant. Yeah. Which is also true in the Philippines, that it's quantitatively small and unimportant. So we will introduce each component. Okay. So first, current account. The current account is the sum of three accounts: the trade balance, the income balance, and the net unilateral transfers. Um, the trade balance. What is the trade balance? It measures the difference between exports of goods and services and imports of goods and services. So you've got the merchandise trade balance, you've got the service trade balance, and then you have the overall trade balance, which is just the sum of the goods and the service trade balance. So these are traded goods and these are traded services here. Okay. So the US trade balance, for example, in 2020, exports of goods and services is 2.1, imports of goods and services is 2.8. The trade balance is a negative number, negative zero point 0.7, negative zero point 0.7 trillion. Okay. So is zero point 0.7 trillion a big or small number? Then you do it you measure it relative to your GDP, or the size of the economy. And we'll see here that the trade balance is a small share of GDP, right? It's just 3% of GDP. Take a look at the US trade balance over time. So this is news to me, actually. In the size of the trade, look at the graph in the next slide, which will show the trade balance since 1960. What's interesting about the US trade balance is that it has declined steadily, okay, from a surplus of three-fourths of a percent of GDP, very, very small, to a negative 6% by the beginning of the financial crisis in the the global financial crisis, I should say, 2007 to 2009. Okay. It seems to have been put to a stop, the decline in the current account deficit since 2009 to 2007 to 2009. And in fact, the global financial crisis was associated with an improvement in the trade balance to recover to about negative 3% of GDP. So let's take a look. So this has been what the US trade balance has been looking like over the past few decades. Okay. Now the Philippine trade balance is very, you can also plot that, and you'll find that the Philippine trade balance has been consistently negative, actually, over the years, even as the current account has sometimes been positive. We can talk about that in a moment, and it should be clear why in a moment. Next, income balance. So another component of a country's current account is income balance, which measures the difference between factor incomes received from the rest of the world and factor incomes paid to the rest of the world. These net income payments are recorded separately for capital and labor. So the net income from capital is called the net investment income. The net income from labor is called the net international payments to employees. So we will now have the income balance here, which is basically the sum of both of them. Okay. In the United States, net international payments to employees has been historically small and is quantitatively not important. However, in the Philippines, this in fact is very significant, has been growing in significance, and we're essentially this entry here, the income balance, is the reason why, despite trade balance deficit, the country, the Philippines, has had on occasion current account surplus because of the income balance. So we have been receiving income from abroad, from particular from our labor earnings from abroad. A third is net unilateral transfers, which basically personal remittances plus government transfers. This is also the other component of the reason why the current account has been rising, or not rising, but at least been positive, despite the fact that the trade balance has been consistently negative. In the United States, net unilateral transfers is negative in most years as the United States makes more gifts than it receives. The most relevant examples of net unilateral transfers includes U.S. residents sending monetary gifts to relatives living abroad, and the United States government sending aid to foreign countries or to areas of the world suffering from natural disasters and so on. So the current account then is the sum of those three things: the trade balance, the income balance, and the net unilateral transfers. Okay. So the table on slide 16, the next one, displays the values of the three components in the United States in 2020. Okay. In the United States, you have the current account to be a negative overall. Okay. And its contribution comes, the fact that it's negative really comes from the fact that the trade balance is negative here. And for the United States in particular, the income balance and the net unilateral transfers, these are essentially very, very small numbers relative to the trade balance, okay, for the United States. Okay. So observations in 2020, the United States ran a large current account deficit. The bulk of the deficit stems from a large trade balance deficit. The country has had a deficit in the trade balance on goods and services in the trade balance and services. Oh, sorry. Has a deficit in the trade balance on goods and a surplus in the trade balance and services. The United States imports manufactured goods and exports human capital intensive services. Thus, the United States typically runs a trade deficit in goods and a trade surplus in services. Net income is positive. Net investment income is positive, which means that investments of U.S. residents in foreign assets paid more in interest, dividends, and profits than the investments of foreign residents in U.S. assets. Net unilateral transfers, net international payments to employees was negative but small. Net unilateral transfers are negative, which means that the United States gave more gifts to the rest of the world than it received. Okay. These are mainly personal remittances of immigrants in the US to relatives living abroad. Okay. So before I continue, just wanted to make sure that people understood sort of the difference, right? So the net for the Philippines in particular, for the Philippines, these personal remittances, they come from people or Filipinos living abroad who are there more or less permanently, right? Whereas compared to the income balance, the net income from labor are those from workers who are working temporarily abroad. Okay, so those are the BOP wants to classify those two different types of labor separately. So the income balance the remittances from workers who are abroad temporarily will be lodged here, right? As net, not here, not investment income, but here, net international payments to employees. Whereas in another situation where you have Filipinos living permanently, or at least the majority of their time abroad, then it will become personal remittances, and it will be lodged here in net unilateral transfers. Either way, those are the reasons why the Philippines would sometimes have a positive current account. We'll have a current account surplus as opposed to a deficit, despite the fact that we have a trade balance deficit. Okay, so trade balances and current account balances across countries. Okay. So the trade balance and the current account often move in tandem. Um, as well as with other countries, right? The figure on the following slide plots the trade balance and the current account as a percentage of GDP. So here we are comparing trade balance over GDP versus current account over GDP for 82 countries in 2019. So most dots will fall around the 45-degree line. The clustering around the 45-degree line suggests that, as in the United States, many countries, the trade balance is the dominant component of the current account. Okay. So you've got this situation here. So what do you notice here, guys? So this situation here means if you're in this quadrant, then that means your trade balance is negative and your current account is also negative. Okay, so they're both negative. So the trade balance and the current account, they go together for these companies. Um, it's also true up here that if you have a positive trade balance, then you have a positive current account. And then these dots here are reflective of those two positive numbers. They go together here. However, that's also possible um, between to have this situation and this situation here. Okay. So what is this situation? The trade balance is positive, yet the current account is negative, right? So guys, I have a quick question. What can make this happen? Okay. And this is just about the definition of the current account, right? If your trade balance is negative, it must be that what?
Sir, mas nag import ka po ng service.
Um, the trade balance, according to this, contains also the trades in goods and services, actually. So this isn't about the trade in goods and services, but if you notice, by definition, see, the current account is equal to the trade balance plus income balance plus net unilateral transfers. If the current account happens to be a negative number, let's go here. If the current account happens to a negative number, but your trade balance happens to be a positive number, then it must be that the other terms are the two other
Negative
components
po.
are negative. The net investment position, the net payment to labor, right, or employees, as well as the net unilateral transfers. Those ones in total have to be negative in order for the current account itself to become negative, despite the fact na positive yung trade balance. So for these countries, such as Argentina, that's the example, right? You have a positive trade balance, but for some reason you have a negative net income, right? From factors of Argentina, for example, living abroad. The next situation here is this axis, this quadrant here. There's only very, very few countries here. In this situation, you have a negative trade balance, but on occasion, you will have a positive current account. Okay. So in this particular case, similar to that of the Philippines, although we don't know which dot here is the Philippines, I would suggest we're probably like down here or somewhere. But um, we're probably like near the border here. In fact, probably. This is in 2019. Kasi let me just check my Excel again. In 2019, negative na yata yung ating current account. Yes, we have a negative current account deficit. So we're probably somewhere around here in the Philippines. Yeah. But sometimes we have a positive current account, which puts us here in this upper left quadrant. So in that case, kahit na negative in trade balance mo, you're on net receiving more income from abroad, and that's why your current account happens to be here. Yeah. But in this particular case, in 2019, I just have the data. Our CA is somewhere around here, right? We are either this dot or this dot or this dot. So the previous figure shows, again, that the current account and the trade balance need not have the same sign, and the current account can either be larger or smaller than the trade balance. And so any sign pattern is possible, as shown in the following table. These are the countries that were highlighted in the earlier slides. So Argentina, Canada, I'm not quite sure what NIC. Nicaragua. Yes, it's the list of countries is down here. So here are some observations on that table. So recall that CA equals trade balance plus net income balance plus net unilateral transfers. For China, the trade balance is greater than the current account. Okay. But then both are positive. Okay. And then they'll note that the income balance is negative. In Germany, the CA is greater than TB, and that's because the income balance is positive. Okay. In Nicaragua, the CA is positive, yet the TB is negative, and that's because net unilateral transfers are large, right? Nicaragua receives remittances equal to 14% of GDP, mostly from the United States. So this is something similar to the typical sort of Philippine case. On occasion, when we have a positive CA. Canada, the income balance is negative, therefore the CA is going to be less than the TB. Okay. And Argentina, you have a negative CA, yet a positive trade balance. It's because the income balance is also very negative in this case. Argentina is a large net debtor, so it makes interest payments to the rest of the world. So that's why its income balance is negative. So any combinations is in fact possible in this graph here. Okay, but most of the time for most countries, you have a positive trade balance, you most likely will have a positive current account. And if you have a negative trade balance, you most likely will have a negative current account. So we'll discuss a little bit the imbalances in US trade with China. Okay. The figure on the next slide shows that a sizable fraction of the US merchandise trade deficit is accounted for by its trade in China. Okay. So here's the total, and here's the merchandise trade in China. Okay. The fraction of US merchandise trade deficit accounted for by deficits with China has widened steadily since China's accession to the WTO to about 20% to near 50% in 2015. Okay. So this is about 2015. So this thing, the total, is about, oh, this dashed line is 50% of this value here, for instance. Next we'll think about basically the whole world, right? The world map of current account balances. If the United States is running a large current account deficit, then that means some other countries must be running current account surpluses. Okay. Why? Because it has to be true that the current account in the US plus the current account in the rest of the world must be equal to zero, right? Because if you're exporting, so again, CA is the net exports of goods and services. So if there's only two places in the world, the US and the rest of the world, if the US happens to be in a deficit, then where do those goods come from? It has to come from the rest of the world. And therefore, the rest of the world must be having current account surpluses. Next concept, guys, is the connection between the current account and the net international investment position. So a country's net international investment position is the difference between its foreign assets that it holds and its foreign liability position. Okay. So the NIIP is equal to A minus L. Okay, the foreign assets minus foreign liability for a country. If the NIAP is negative, that means A is less than L, then the country is a net debtor to the rest of the world. If NIIP is positive, then the country is a net creditor to the rest of the world. So the concept of the current account balance is economically important because it reflects a country's net borrowing needs. For example, in 2020, the United States ran a current account deficit of 647.2 billion, okay, which we talked about earlier. To pay for this deficit, the United States must either reduce its international asset position, A, okay, or increase its international liability position, L, or both. That is, the current account deficit reduces the NIIP and a current account surplus increases it. So there's a connection, a deep connection between the current account and the net international investment position. Okay. It will be clear in a moment, but the NIIP is a stock, right? How much assets you have. Whereas the current account is a flow, right? Which will dictate the change in the net international investment position or the change in the net foreign assets that a country has. Okay. Let's go to the next slide. Hold on. There you go. So here is the US current account and its net international investment position. So what you should be thinking about here, guys, is NIIP here is a stock and the CA is a flow. So if this one, for example, if the CA is negative, it's in the negative territory, then that means the stock must be falling. So in the case where the red line is in the negative part, I'm just gonna choose this part here. This is the negative part, yeah. And that means, as you'll see, generally speaking, your net international investment position is falling. So that's how you should read this because technically NIIP is a stock. So you should think about CA, which is a flow, as the changes in NIIP or the direction of change of NIIP. It's falling or rising over time. Um, so all else equal, the net international investment position increases when the current account is positive and decreases when the current account is negative. Thus, the current account is a flow and the net international investment position is a stock variable. So as we saw earlier in the United States, the current account is similar in size to the trade balance. Okay. So in the analogy of the tank, periods in which the water flow entering the tank through the pipes is smaller than the flow of water leaving the tank typically represents periods in which imports of goods and services are larger than exports of goods and services. In other words, it's a CA deficit. Okay. In other words, other components of the current account, um, of course, other components of the current account, such as the net investment position, net unilateral transfers, are also part of the flows of water. But again, for the United States, the trade balance is the predominant, the most powerful thing that's driving the current account for the United States. Now, our final theoretical topic here is, in fact, what's called valuation changes. So if you look again at the graph in slide 30, notice that not all years in which the current account is negative corresponds to years in which the NIIP falls. So this is particularly evident just before the beginning of the global financial crisis in 2007. In general, changes in the NIIP are not always exactly equal to the changes in the CA. Okay, so first, let's look at this period in 2007. So if you look at this, okay, notice that you have a negative CA here, right? But what's happening to the NIIP position? It's rising here. So there are, in fact, stretches of time where you have a different direction, right? Even as the CA is negative, your NIIP could be rising or the opposite. Even if the CA is positive, it could be the NIIP is in fact falling. And the reason for that is because of these valuation changes. Valuation of what? The valuation of the assets. Okay, because again, the CA is about the change in the assets, correct? Change in the holding of the assets. But then the value of the assets could change not just because of the how much assets you have, but also in terms of the valuation of them. Okay. So, yes, the NIIP can also change when the market value of a country's international assets or liabilities changes due to movements in stock prices, bond prices, or exchange rates. This source of changes in the NIIP is known as valuation changes. So, in fact, the change in NIIP, which is the change in the net asset position of a country, is equal to CA, or the current account, okay, plus valuation changes. Okay. Plus valuation changes. And valuation changes are changes in the market value of the country's foreign asset and liabilities position due to a currency appreciation or depreciation, changes in stock prices, and so on. So let's go through some simple examples of how valuations can change. So here's an example. You have assets A, 25 shares. Here again is the from the perspective of the United States, but it can also be from the perspective of the Philippines. The price of each share is 2 euros, right? The exchange rate is $2 per euro. Then the assets will be $100, right? So notice you have to convert the foreign assets into domestic currency, right? So these are foreign assets, but denominated in the domestic currency here. International liabilities are assets held by foreigners, um, U.S. assets held by foreigners. So 80 U.S. bonds are held by foreigners. The price is $1 per unit. Then the liabilities of the United States is 80. Okay, so this is the liabilities, and these are the assets. So the NIIP is equal to assets, the assets owned by the United States, the foreign assets owned by the United States, and then L, which is assets held by foreigners of the United States, right? And that's gonna be 100 minus 80 equals 20. Okay, so that's your NIIP. But now you have a depreciation of the euro. So suppose the euro depreciates to 1. So therefore, your assets will fall in terms of US dollars to 50. L is still equal to $80 because US bonds are all denominated in dollars and therefore are unaffected by the euro's depreciation. So the NIIP will move from 50, move from, what's the value earlier? From 20, and it's gonna be negative 30. So notice that the NIIP changed from a positive number to a negative number because now, because of the depreciation of the euro, which will change the US dollar value of your foreign assets. Okay. Conclusion, just because of a change in the exchange rate, the country went from being a creditor to being a debtor of the rest of the world. Okay. Because of the market value of these assets. Here's another example of foreign equity prices, which feel free, please read through the example, but it works almost exactly like the previous example, right? And the conclusion is the above hypothetical examines examples illustrate how a country's net international investment position, the NIIP, can display these large swings because of movements in asset prices or exchange rates. Okay, so this is the case in actual data as well. So in particular, we're going to look at valuation changes in the United States. Okay, the valuation changes can be large. We have observed valuation changes as large as 15% of GDP. So they're in fact larger than the current account changes, guys. Okay, potentially. Over the period 2000 to 2010, mostly valuation gains for the United States. Since then, mostly valuation losses. Large valuation changes are a recent phenomenon. Until the year 2003, the typical valuation change was only plus and minus 3% of GDP. So here's the plot of just purely the valuation changes and how that contributes to NIIP, okay, as a percent of GDP. Okay. Oh, sorry. Uh, Valuation changes before the global financial crisis from 2002 to 2007. From 2002 to 2007, the US cumulative CA deficit was 3.9 trillion, yet the NIIP improved by 80 billion. Okay? So normally, again, if you have a trade deficit, CA deficit, current account deficit, you should have a lower or more negative, a lower NIIP, right? Possibly even a negative NIIP. But instead, it improved by 80 billion US dollars. That means that valuation changes during this period amounted to almost 4 trillion. Okay. The main drivers were the dollar depreciated by 20%, and the stock markets in foreign countries significantly outperformed the US market. cumulative return from 2002 to 2007 is 190% abroad versus 90% in the United States. As a result, the US net equity position went from 0.4 trillion to 3 trillion in 2007. So there are these large positive valuation changes came to a sudden stop in the global financial crisis in 2008. That year, valuation changes were negative 15% of GDP, mostly from an enormous drop in foreign stock markets. Here we'll have a hypothetical NIIP that excludes valuation changes. Okay. The figure on slide 43 shows the cumulative impact of valuation changes on NIIP. It plots the actual US NIIP since 1976 and a hypothetical NIIP constructed by removing valuation changes. So the hypothetical, guys, is just the starting NIIP, and then you're adding all of the CAs, the current accounts, which are either in surplus or deficit over time. So what you're removing here, guys, is the valuation changes. The point of this graph is to show how important valuation changes are. So notice that this is the hypothetical NIIP, which is just the sum of all of the CAs plus the initial NIIP, of course, right? Which is this is the initial NIIP. But notice that the blue line is always above the red line, the red dashed line. And this shows you that you've got this positive valuation effect, which will tend to raise the US NIIP higher because essentially you have the foreign assets held by Americans are essentially increasing in value. Okay, in terms of the domestic currency, the US dollar. And as you can see here, the valuation effects can be quite large. Okay. Um, Gross positions and valuation changes. So take a look at the the figure in the next slide. It shows that gross positions have expanded enormously since 2000. Okay. So US owned assets abroad and foreign owned assets in the United States. So the US owned assets are growing and foreign owned assets are also growing over time, right? Okay. So the gross possessions are all about the absolute value, guys, of the A, or the foreign assets held by the country, and L, which is the domestic assets held by foreigners. Yeah. So these gross possessions, when they are large, okay, can have large, therefore, if you have valuation changes, can have large effects on your NIIP, as opposed to when the gross positions are, in fact, quite small, right? Even if you have large valuation changes, if you have small gross positions, your NIIP will unlikely change much because of valuation. So here's just a simple example of that. Suppose you have in country X, your A equals L equals 1. So basically your NIIP, your net position here is 1, 0, I should say. 1 minus 1 is 0. And in country Y, your net position is also 0. But look at your asset size. It's 1,000. It's 1,000 times that of country X. Now, well, GDP is the same in both countries, for example. NIIP is 0% of GDP. Now, suppose the value of foreign assets increased by 10% in both countries. This causes the NIIP to go from 0 to zero point 0.1 in country X. Right? It will increase, of course, but it won't increase by as much as in country Y. Okay, because the NIIP will go from 0 to 100 in country Y, and therefore the NIIP increases to 0.1% in X, but 100% in country Y. Therefore, the larger the assets that you have, the larger the effects of valuation on NIIP. Okay? Because of just by virtue of the fact that you're playing with more larger assets, right? More assets. Therefore, changes in the values of those assets will be much larger as well. So this is a situation for lots of developed countries, and which is why their situation, their country, their asset sizes are essentially similar to this, right? For countries whose asset sizes are small, especially relative to their GDP, right? the valuation effects will be a much, much smaller because of that. All right, so this is in fact, the slides will continue, but these are the only real concepts I want everyone to focus in on in chapter one of global imbalances. Okay. We'll end there. I think by Thursday when we meet, we will finish all the way till the third or the fourth chapter. So the second chapter is very, very quick. So that's not really too much of an issue. But the third and the fourth chapter, that's probably will end on Thursday. There's a chat question. No, it's only until slide 46 here, which is where we'll end. Um, So until valuation changes, and what are valuation changes, Jada? Okay, so I will be saving the this recording, and then I will be uploading this recording on Tuovle. Okay. Also, James, I will be issuing a correction as well for the homework. But as hopefully everyone has done the correction, the actual demand function everyone should have it because it will be clear that there was a typo. Yes, James.
Sir, regarding po for yung laman po ng final, hanggang anong chapter po ng international macro yung kasama po?
It depends on hanggang saan tayo abot. I would suggest we'll probably end by chapter 3, which is the next. There's still two more chapters after this. So hanggang chapter 3, something like that. Maybe chapter 4. The reason why is because, again, you've seen all of this. The only reason we took a while here in the beginning chapter is because there's a lot of concepts that we have not yet been introduced to, such as the current account, the trade balance, and the net international investment position. Okay. But once you have those concepts, the actual theory will be, again, very, very familiar to you. Any other questions? Okay, so with that, I will close this meeting. Expect an upload. It'll probably take maybe 20-30 minutes for the whole process to finish, but I will share the video in a moment, and I will issue a correction for the homework as well right now. All right, bye guys. Thank you. Take care. See you on Thursday.
Thank you, sir.